Welcome to Man Does Tech, where I solve the problems you didn't even know you had.
In this video, I will explain how to use time frames in Forex. Understanding time frames is fundamental for any trader, as they dictate how you view market movements. Each candlestick or bar on your chart represents a specific period, from 1 minute to 1 month. This choice significantly impacts your trading strategy and overall market analysis, helping you make more informed decisions. Forex offers a wide range of time frames, generally categorized into short, medium, and long-term. Short-term frames, like the 1 minute or 5 minute, are ideal for scalping and quick entries. Medium-term frames, such as the 1 hour or 4 hour, suit day traders and swing traders. Long-term frames, like the weekly or monthly, are best for identifying major trends and long-term investments. A powerful technique is multi-time frame analysis. Begin by examining a longer time frame, such as the daily or 4-hour chart, to determine the prevailing market trend. Once the trend is established, switch to a shorter time frame, like the 15-minute or 1-hour chart, to pinpoint precise entry and exit points. This method helps confirm your trade direction and significantly enhances your trading accuracy. Selecting the right time frame depends entirely on your trading style and objectives. If you are a scalper, aiming for quick profits, 1-minute or 5-minute charts might be suitable. Day traders often use 15-minute or 1-hour charts. For swing traders, who hold positions for days, 4-hour or daily charts are more appropriate. Always consider your risk tolerance and available time for market monitoring.
Thanks for watching. If you found this helpful, don't forget to like and subscribe.